Okay, that you know what? That gets my attention too, especially hearing you as someone you came from the world of like being an equity fund manager as well, and people have the trade all wrong. Question for you. Why do they have it wrong? Are they getting the inflation story wrong? Like what is it that they're missing?
Well, so there's two types of Wall Street is silent. So when I was at BlackRock, I was an equity portfolio manager, but I came from a fixed income background. I worked at HSBC as a bond salesman, so I had the ability to kind of look at both sides of the trade, and a lot of my greatest calls were looking at bond markets, telling me equity markets would follow. So what I'm talking about is mostly asset allocators. The amount of bullishness in the stock market and the amount of money being allocated to equities is quite high and to bonds quite low. And so as this trade unwinds, there'll be a giant sucking sound from equities to the bond market. And Scott Beston, who's wants to refinance, Janet Yellen did a lot of front end loading of the Treasury.
Yeah, the short term issuing of the short term paper, right?
Yeah, the correct. And so that's third world behavior. And so people have been saying, well, there's no way we can sell those bonds because everyone's selling treasuries right now. Well, that's going to reverse in a recession. So Scott Besson's going to be able to term that out longer term, and a recession would help him term that out. It's actually, I think that's how it's going to play out. Once the general market, if we're right, if our thesis is right, once this begins, it'll be quick and fast.
Okay, so you think this sell off in the general like stock market will be fast? Can we explore that? Is it because of the massive passive bid that's out there too that would be the accelerant, or just kind of curious? Like,
well, so in the old days, when I was running money at BlackRock, 70% of the equity money was run by fundamental investors, meaning portfolio managers and or private investors. 95, that's the trend since I left, and the trend was already underway when I was at BlackRock. There was a trend from fundamental active investors to passive. The stock market is now comprised, the volume, like I said, it was 70% fundamental investors back during the great financial crisis. The volume now is 5% fundamental investors, 95% passives and algorithmic trading. So that's the case could be made that the stock market, which used to be a good indicator, a leading indicator of the economy, isn't so much anymore because a lot of the headline numbers have been strong GDP, the employment numbers. There's been a lot of controversy about the employment numbers and thoughts that they've been padded statistically. There is some proof for that. There's something called the QCEW, the Quarterly Census of Earnings and Wages, which is kind of the reality. In my whole career, we never cared about that report because you didn't need to, because the difference between the non-farm payroll, which is the estimate and by the way, these reports are done by the same agency, the BLS. They usually, net it out to zero. Well, it came out, the last QCEW came out in June, and it was a 7 sigma difference from the establishment survey to the tune of 1.25 million jobs. So we talk about that in our report, not the QCEW per se, but we think that the difference has been illegal immigration and the real average American is having a difficult time finding a job, and these have been low-end wage jobs.
I want to come back to that too, because you did bring that up on the last episode. But just this notion of if you see the sell-off and it's going to be really fast too. Does that? And you mentioned at the top, like recession. Okay.
When I say fast, I don't want people to think it's crash. I mean, there's two ways this can go. This can be we're not thinking this is going to be systemic. Systemic is when you have a plumbing issue in the credit system and things, you have, just collapses all over the place. The 2000 recession was more of a 50% drawdown in the stock markets over 2 years. So it could be combination. It could be slow like that, fast if we go systemic, or a combination of the two. But once the trend reverses, you still got time to make, realign your portfolios. But I think it's going to be quicker than we think.
But just going at the top, you mentioned that recessions aren't necessarily something to be feared. So I'm asking this, like, could it create an opportunity, maybe a bit more of like a generational opportunity, like for I don't know, entry point for folks? I don't know
Yeah.
if this.
So like people are always looking at stock market corrections and housing corrections as bad. They're not
Yeah.
necessarily bad unless you're over levered and up to your eyeballs in debt. Now, the good
Mhm.
news is most millennials want to buy a home.
I wanna buy a house so bad,
Yeah.
Ed. Yes, so
Yes.
bad.
Millennials want to buy a home. They'd like to be able to invest at lower stock prices, not at generational high valuations. That's why Warren Buffett's out of the market. He's not stupid. Um, so this creates a huge opportunity for it's a transfer of generational wealth, essentially. And it needs to
Mhm.
happen, quite
Yeah,
frankly.
yeah. I got a viewer question recently. It was a really long email, but maybe I'll see if I can condense it down a bit because you might be a guest who could answer this. Um, First of all, are you someone who do you have dry powder? Are you one of those folks who are kind of waiting for opportunities by any chance?
Yeah, that's what I've been
Okay.
recommending. Look, I was
Okay.
early. I've been saying for the last year, I had some dry powder. So that call's been a
Yeah.
little early,
Okay. Well, I
but
got this really nice email from this guy. Shout out Michael in New Jersey. He said I remind him of his daughter. So I remember this email and I'm like, I have to pull it up. He said a number of your guests have mentioned that they are sitting on dry powder, waiting on good opportunities. They also talk about the possibility of extended down market conditions. They point out time periods in the past where they profited by buying in down markets. So he has a few questions. You don't have to answer them, but if there are any that are relevant, he said, "What are some examples of companies or industries that were bought in previous down markets, and what were the circumstances that caused them to buy those industries?" Same questions for the next downturn. What are the signals that it is time to start buying? PEs declining to a certain point or range, price percentage declines, etc. When they start buying, do they wait in over time periods of months, years, etc.? If they're 50% liquid, what conditions determine the speed at which they deploy capital into purchasing assets? He just asked a bunch of questions, but if there's anything in there that you'd like to pick, it might be nice to answer because I love my audience and I love when they write in. So if there's anything that's relevant to you
well,
that you might be able to share.
let's say you already have dry powder. If you're sitting on dry powder, then you have to figure out when you redeploy, right? That's when you redeploy, and without trying to pick, there's a couple ways to do it. Not trying to pick the bottom. So if the market goes down 30%, maybe you throw 10% back in of the dry powder, and you kind of at dollar average in, knowing you're not going to pick the bottom, but you're getting overall you're buying at lower and lower prices. Or if you're more of the person that wants to pick the bottom, which is very difficult. Typically speaking, bottoms are marked by huge volumes of selling and awful headlines that the world's coming to an end. The other thing you can look at is you can look at different stocks and industries if you want to be more adventurous. Back in the great financial crisis, things were awful. We were scared, even we were, those of us who managed money were fearful. But you have to kind of overrule your emotions. And there was this one point when NVIDIA, before its current incantation of AI, reported down 50% revenues and down 50% earnings, and the stock was down, I think, around $2.70. And the stock didn't go down on that news. So that's an indication. And I remember talking to a friend of mine. We bought the stock hand over fist, even though it sounded awful, because how much worse could it get than that? That's kind of, it's the second derivative. So this is so bad. It's going to get better, at least over the next year, somewhat. And then the stock took off, throughout all of 2009. So there's a bunch of different strategies. For the average person who has a job that can't monitor this every day, I would just, start with 5% increments. And, if we're right, we get a correction, just start slowly reallocating money in until, you won't catch the bottom, but you'll be better off than 99% of the people who are all in.